Okay, I think we're going to go ahead and get started. Again, welcome everyone, and thank you for taking a little bit of time out of your day to be here. Today, we're going to be talking about understanding some of the different ways for you to be able to save for your future. And I'm sure for a lot of you, you've heard terms like pre-tax, after-tax, or Roth contributions. And our goal today is to help you to kind of make sense of all of these terms, and then most importantly, be able to walk away with an actual plan or a saving strategy for yourself. Here's a quick look at today's agenda. We want to start by talking a little bit about some of your fundamental saving options, particularly your employer-sponsored retirement plan. Then we're going to move into helping you to distinguish between pre-tax contributions and Roth contributions. We're also going to talk about the differences between Roth and after-tax. And then from there, we want to make sure to hit on some of the other situations that some of you might have as it relates to your situation as well. For some of you, you might be contributing to an HSA or a flexible spending account or maybe a 529 plan. And so we want to make sure that those accounts are also being incorporated into the plan that you have for yourself. And then lastly, we want to give you some easy next steps that all of you can take to be able to take the information from today and to be able to apply it to your individual situation. I'd also like to introduce our presenters today. My name is Kyle Bingham. I'm the Managing Director for Financial Fitness for Life. Joining me today is Christine Nakunin and Kenji Noguchi. These are two of our financial fitness consultants. They've had years of experience with sitting down and working with hundreds, if not thousands, of plan participants. And so they'll be able to give their unique insight into today's topic as well. And then we also have Matthew Eichmann joining us today. He's our National Retirement Practice Leader from Qualified Plan Advisors, and he's got some important knowledge that he'll share with you about saving for retirement and some of these different terminologies and how to apply them. And with that, let's go ahead and kind of kick things off with this idea of fundamental saving options. And I think for a lot of you, that's probably going to be that employer-sponsored retirement plan, your 401k or your 403b. And as we kick things off, I think what I'd like to do first is ask the question of, why do we save? Why is it so important to be saving for our future? Why is it important to take advantage of these types of retirement accounts? Well, I think there's three primary reasons. First and foremost, it allows you to save for retirement, right? There's a lot of responsibility that's placed on our shoulders as we kind of create that nest egg and build that nest egg. And so your employer-sponsored retirement plan, it's a great and convenient place to start. As you start to use those employer-sponsored plans, it's also going to be a bump in your confidence, and it's going to help you to feel more secure. I think that when we can focus on our individual situation and focus on the things that we can control, that's going to be that immediate boost in confidence. And like I said, we want to make sure that each of you have a plan for how you're saving for retirement and saving for your future. And then lastly, the government provides tax advantages to incentivize saving in these types of accounts. So we're also going to talk about some of those incentives or some of those benefits to make sure that you're maximizing those to the best of your ability. And with that, what I'd like to do is turn the time over to Kenji. Kenji's going to walk us through what a salary deferral is and start to talk to us a little bit more about contribution types and the overall framework for these employer-sponsored retirement plans. So Kenji, take it away.
Thank you, Kyle. And thank you everyone for joining us here today. So what is a salary deferral? And really, a salary deferral is when an employee elects for a portion of their salary to be contributed to a retirement plan. In other words, what they really are doing is deferring some of that salary today to save for their future retirement. And these deferrals, they can be done on a pre-tax, and we commonly call that as a traditional, or on an after-tax basis. And I'm sure you're thinking, well, what's really the difference? And what it boils down to is the type of tax advantages you receive by choosing one or either of those options. Now, we'll certainly address what those are and how they can affect you as a participant. But before we do, let's do a quick review on what the contribution limits for 2023 are. So as we look at this slide here, it's very clear that IRS is incentivizing us to save even more. So for 2023, the contribution limit is going to be $22,500. Now, the sum of your pre-tax and maybe even your Roth contributions, they can exceed that IRS limit number. What I mean by that is, let's say you contribute about $10,000 into the Roth deferral side, you would then only be allowed to contribute $12,500 either as Roth or pre-tax. You can't exceed that limit there. Now, obviously, if you are over the age of 50, you do have that entitlement to contribute just a little bit more, and that's going to be our catch-up contribution. For this year, it's $7,500. So keep in mind, if you're over the age of 50, you could actually get a total of $30,000 into that retirement plan. Now, as far as these goes, I really want to distinguish between pre-tax and Roth and what advantages they might come. So I actually segue this over to Christine here, who will be able to break that down further.
Perfect. Well, thank you for all joining us. So in your 401k or 403b, many of you have a choice of how you can put money away. And so historically, most of you that are on this call have pre-tax contributions, or what I oftentimes you'll hear me refer to them as your traditional contributions. And the advantage for this is you're going to put money in, those dollars that you elect to, those salary deferral dollars you elect to put in are going to reduce your current income in the year that you put those dollars in. Those dollars are going to grow for you tax deferred, but at retirement, you'll take those dollars out and you will be paying taxes on the amount that you initially contributed as well as the investment growth. The idea is that hopefully you might be in a lower tax bracket at retirement. And to give you an example, let's say you're making $80,000 a year and you elect to put 10% of your pay away. So that would be $8,000. If you do that pre-tax, when it comes to pay your taxes for this year, rather than showing the government that you made $80,000, you'll only be taxed on $72,000. That $8,000 you put away for retirement, that is tax deferred. Now another option, and this one is rather new for most people, or you might think it's new, but it's actually been around for about 20 years. It's just recently that more employers are adopting what is referred to as the Roth contribution. Now there's tax advantages for using the Roth, but they come later. So with your Roth contributions, you're going to put dollars in that are after tax dollars, but they're going to grow tax free. And when you're ready to take them out at retirement, as long as it's a qualified distribution, it will be a tax-free distribution. So what's a qualified distribution? You have to leave the Roth dollars in your account for 5 years from that initial contribution. So there's a 5-year clock, and then you have to be 59 and a half, or in the event of your death, it'd be paid to your beneficiaries, or if you would become disabled. All are qualified distributions. So going back to my example of somebody making $80,000 this year, if you put that 10%, that $8,000 away in your Roth portion of your retirement account, those dollars again will grow tax-free, but when you go to pay your taxes, even though you put $8,000 away, you're going to have to pay taxes on that $8,000. So if you don't have that tax advantage now, but you have it down the line. So what does this mean to your paycheck? Angie's going to show you some actual examples.
Thanks, Christine. And let's take a look at this illustration. I think it's very powerful. We have our pre-tax bucket and our Roth bucket here. And let's go over our assumptions. So we're going to assume Social Security and Medicare, we're at the tax rate of 7.65%. We're going to have federal at a rate of 12% and state at a rate of 4.5%. Let's focus on pre-tax first. Let's assume that you earn $1,200. You want to defer 10% into your plan. It's going to be $120. Now, since you're using the pre-tax option, you do have that benefit up front. So as much that is going to be actually subject to income tax is going to be $1,080. The difference from that $1,200 and that contribution of $120. Taxes paid, how you'd find that is going to be based off of that $1,080, and you're going to multiply that number by the Fed tax rate and your state tax rate, and you have an understanding of how much you're actually paying. Social Security, Medicare, we're going to have at that rate a 7.65, $91.80. Let's paint the picture. Let's take a look at the Roth side. Same assumptions, $1,200 in wages. You're going to be putting the same amount, 10% into that 401k. However, the amount that you are going to be subject to tax on is that full $1,200. Again, you're paying the tax up front. So what I want you to really note on this illustration is that taxes paid column. You are going to see there is a difference. As we move to this next slide here, let's really further break it down. What's the same and what's actually different, depending on which choice we make. So what's the same is how much you earn. Your gross wages is going to be the same. How much you're actually contributing into the plan is going to be the same, as well as the amount that you're paying tax-wise into Social Security and Medicare. Those are all going to be constant for you. Now, what's different is, again, that taxes paid column. The Roth contribution, you're paying that tax up front on that full $1,200, whereas the pre-tax, you're paying it on that reduced amount of $1,080. So there is a difference on your paycheck. If you choose the Roth, you're going to have a little bit less than if you did for the pre-tax option. Now, a lot of good things to consider here, but there's certainly other things that we should consider too. So I'll move back to Christine here, and if you can, please break down what some of those might be.
Yes, there are some additional contributions. And so the first one is, it's not an all or nothing with traditional pre-tax or Roth, the after-tax choice. You can actually, within your plan, participate in both. It's just you cannot exceed that income limit, which for 2023 is $22,500. Now, a lot of people are often confused with the Roth 401k or 403b and the Roth IRA, which is an individual retirement account, and the differences from that. So not everyone can participate in a Roth IRA. There are some income limits based on your adjusted gross income. And those essentially, that the more money you make, those individuals, those highly compensated individuals, can't use a Roth individual retirement. One of the great features is if your plan does offer the Roth is that it doesn't matter what your income is, as long as your employer offers it in their plan, you can be a highly compensated individual and still put money into your Roth 401k. The other great advantage is that you as an individual can put a lot more money in your Roth 401k compared to a Roth IRA. The maximum this year you could put in a Roth IRA is $6,500. And if you compare that to what you could put in your Roth 401k or 403b, that's $22,500. In addition, if your employer matches, you're not going to get a match by putting that money in your IRA. You're going to get the match by putting it in your 401k. The other thing to consider is that currently employers match pre-tax. So even though you might elect to put all your money in Roth out of your paycheck, your employer's dollars are currently going to be going in pre-tax. However, this may be changing. As part of the Secure 2.0 Act that passed at the end of 2022, employers have the option to start making contributions from the employer side that match as Roth contributions. So, Kenji, why might using those Roth deferrals really be appealing for an individual?
And I think that's a $1 million question we all have, right, Christine? Well, there's a lot of reasons. And I can tell you, at least from my perspective, a younger individual, early still in the workforce, it gives me tax diversification, firstly. As you said, right, many times when we get a match, it's going to be on a pre-tax basis. So when I choose Roth, I have that diversification in my actual retirement nest egg, where when I begin pulling it out and go through a drawdown strategy, I have options and flexibility. So I like that. Another is that I couldn't tell you what the market's going to do in 5, 10 years. I couldn't tell you what our tax rates may be. So there's a lot of variables and what ifs is what I like to call it. By choosing Roth, I almost eliminate some of those variables. And the benefit for me is that I have time for that earnings and investment to grow. So for me, it's very attractive. And very lastly, it's predictable. Let's paint the picture. Let's fast forward to retirement. And let's say you have an account that's fully Roth monies, and let's say something happens and you have to upgrade your roof at your home, right? When you look in a Roth account, that true dollar that you pull out is exactly what you would need. And let's flip the switch. Let's say if you have a pre-tax bucket and you need to pull that same amount, you'll have to account for a little bit more of that mandatory withholding when you go through that distribution. So ultimately, it's predictable when you have a Roth account. You know what you have and how much you can pull out and not have to pay those taxes. I know there are some other things here that we might be able to take away from this. So Christine, I'll pass it back to you here. Is there anything else that you could think of that could be attractive for an individual, maybe who's not young like myself?
Well, as an experienced worker that is a little closer to retirement than Kenji is, I sometimes may use the traditional because I may be looking to reduce income. I know that my tax rate will be lower in retirement. However, I do still think it's important to diversify my investments in terms of my investment accounts in terms of when the taxes are going to take place. So other key takeaways are that, again, the Roth contributions are going to be after tax for you. And so again, you don't pay taxes on these dollars until you start to take them out. You don't pay taxes on those dollars during retirement, which is a nice feature. In addition, as Kenji said, it does give you that tax diversification. And so for me, I think that's an important piece. Even for a high income earner, having diversification is really important once you're retired, having those different taxes. And as well as just a reminder that the amount you can contribute to your Roth 401k or 403b is $22,500, much higher than if you were doing a Roth IRA. And Kyle, the next slide, I think I've already covered.
Okay, great. Well, Christine, Kenji, thank you for taking a few moments to kind of give your insight into all of this. Now what we're going to do is we're going to shift gears a little bit because we're going to talk about Roth versus after tax. And what I'd like to do, I'm going to bring Matthew on and let him walk you through kind of how to distinguish between the two contribution types. Matthew?
Yeah, thanks, Kyle. And I want to be pretty brief on this because we really only want to hit this at a high level so that if you hear about the difference in the different types of after-tax contributions, you have a little bit of the background so that it makes a little bit of sense. And, you know, we showed earlier on that it's not quite as simple as just having pre-tax or after-tax. But in fact, if you look at this little flow chart, there's really kind of two different kinds of after-tax contributions. We've talked predominantly so far about Roth contributions, right? But we want to address just a little bit this other subcategory, and those are these after-tax employee contributions, or what I'm going to describe them as non-Roth after-tax contributions. And Kyle, as you flip to the next slide, we'll see a little chart here that'll help us. And so the left column under the traditional, the middle column under the Roth. I think Christine and Kenji have done a nice job kind of comparing and contrasting those two. But I really want you to focus now on the two columns on the far right. So let's talk about Roth after tax, and most of this will be a recap of some of what Christine and Kenji worked through, but those are the contributions that are taxed now, and then when you take the money out later, as long as it's a qualified distribution, you don't pay taxes on the earnings then. We combine those with your traditional pre-tax contributions as far as the application of the federal limit, which is $22,500 this year. And then there's some limited withdrawal capabilities that allow you to be able to take that money out, but still meet that definition of a qualified distribution. Okay, so what about this column all the way on the right, right? These are our after-tax contributions that are not Roth. Okay, they're older than Roth, but they're much less used than Roth. Those are the contributions that you put in now and you get taxed now, and then hopefully they'll grow over time. And then when you take your distribution later, you actually do pay taxes on the earnings that you would have on these after-tax contributions. They're not included in that federal limit that we've been discussing, but you do have additional flexibility where you can take those out. But really, let's focus on the key differences there. You pay taxes on the contributions and you pay taxes on the eventual earnings. So you might be wondering, well, why would anybody use these? Why wouldn't I use the Roth where I get that advantage of not having to pay taxes on the earnings? And you might even be asking, well, why are we talking about this today? And so Kyle, on the next slide, there's just a couple points that'll help to answer those questions. Number one, in recent years, we've had more employers saying, let's go ahead and put those non-Roth after-tax contributions into the plan for a couple of reasons. Number one, well, we can allow people to accumulate within the plan kind of an emergency savings account bucket. Remember how I said there aren't restrictions on your ability to take those distributions? So that might be a nice place for you to be able to put a little bit of money aside and know that you can get to it. And secondly, there was a big Wall Street Journal article that talked about this ability to make after-tax contributions to the plan and then accomplish something called a mega backdoor Roth conversion. Sounds really fancy. Well, it is fancy for some, but it's actually a little complicated. And so employers have looked at that and they said, you know, we're probably not going to add a lot of that to our plan. We have the pre-tax option, we have the Roth option that gives our people the opportunity for diversification. And so if you're out there and you don't have this opportunity and you're wondering, why don't I have it? It's quite likely because there's these federal rules that make it hard to be able to do it and pass these non-discrimination tests. So a lot of employers have looked at it and said, we're probably not going to go down that road. But the final reason we wanted to bring this up really quickly is that in a new law that Christine referenced earlier that was passed in December of 2022, there was created this new capability for you to build within your plan something called an emergency savings account, or an ESA. And in short, what that will allow is for you to put after-tax money into a plan and for that to grow up to a balance of around $2,500. You're going to start to hear more about that. And in fact, there's some blurring of lines between after-tax non-Roth and after-tax Roth that we'll be able to get into as more employers start to use that. But Kyle, that was really my attempt just to say there's an issue out there that gets some headline exposure. We hear about it. There was a Wall Street Journal article. There's a new law. People be talking about it. But I think now it's time to become a little bit more practical again. And it would be appropriate, Christine, for you to be able to walk through and say, hey, let's ignore what Matthew talked about for a little bit. Let's talk about all these other avenues you have where you can put money away and find different tax advantages to how you do that. So Christine, can you walk us through some of those?
There are several others. So I talked a little bit earlier about IRAs, again, individual retirement accounts. Those are something that you as an individual open compared to your 401k or 403b, which are employer-sponsored benefits. So there are two types of IRAs. You can do a pre-tax traditional. Again, there potentially could be some tax advantages when you put the money in, but those dollars are going to grow tax deferred and you will pay taxes when you take that money out at retirement. There's the Roth IRA. Again, you're going to put after-tax dollars in, they'll grow tax-free, and then as long as it's a qualified distribution, you'll be able to take those dollars out. There's also offered by some employers what are called cafeteria plans, and then there's also some flexible spending accounts which are used for medical, to pay for your medical benefits that you might need. Now with the flexible spending account, I personally, that's something that my family uses, and we use a PPO for our medical insurance. And I put money in because it's going in pre-tax, and as long as I use the money for expenses such as everyone in my family wears some type of eyewear, so contacts and glasses and going to the dentist and visiting those co-pays at the doctor, I can draw those dollars out without having to pay taxes. The one limitation on my flexible spending account, though, is it's a use it or you lose it in a year. So I have to carefully figure out how much I'm going to put away in my FSA and make sure that I've got medical costs that will cover that. Now, Kenji, on the other hand, uses something called an HSA, which provides a different type of benefit. And Kenji's going to give you a little bit of his perspective on how that HSA works.
Thanks, Christine. And you're right, the health savings account, it is very attractive for a younger, healthy individual. Now, one thing to note with the HSA is that you have to be enrolled in a high deductible health plan to have entitlement to open that account. One other thing to note is you can have both an FSA or an HSA. You have to pick one or the other. Like the FSA, the HSA, you still are putting pre-tax contributions into the account, and you will have earnings and growth not subject to tax as long as you utilize that for qualified medical expenses. Now, that could be exactly as Christine said, going to the eye doctor, going to your dentist, and you name it. Now, why I like it is it's flexible, there's tax-free growth, and it does move over year to year. I don't lose it after a year. So let's paint the picture, right? Let's say I'm healthy for a year and I've contributed to the account. It'll roll over next year for me to still utilize and continue my growth. And at the same time, let's say maybe I left employment, I would still have that account to utilize as a safety net. So for me, it's really attractive in that I have long-term savings potentials due to that tax-free growth. And if I foresee myself to be healthy and have predictable medical needs, it's just another retirement bucket that I might be able to use when I start drawing down in the future. So it's a very valuable tool, and I encourage you all to take a look at those and see what you have. The very last one on this list is our 529s. I won't steal Christine's thunder. I know she's really passionate about these. So Christine, I'll actually pass it back over to you. Can you tell us what it is and what scenarios might someone use a 529?
Of course, I am passionate about it. With 2 kids in college, I value my 529 plans, which is a tax advantage way to save for a child's education. And all 50 states offer 529s. You put after tax dollars in, those dollars grow tax-free as long as the withdrawals are for educational expenses. Now, I could spend hours, which I will not, talking about the advantages of 529, but just keep in mind, you've got a variety of different ways that you can be saving in different types of tax advantage plans.
Excellent. And Christine, Kenji, Matthew, thank you again for all of your insight into some of these different topics and some of these things that we need to be kind of considering as we're going through kind of our saving strategy. So what are some easy next steps that you can take? Let me kick it back again to Kenji and Christine. Just talk to us about what each person tuning in today can do to help to kind of solidify their plan, or even start the process of creating that plan for how they're going to save for their future.
And I think the starting point for everyone here in attendance is to log into your plan account, see what you have, see how you're saving and at what rate. Again, it's about knowing what you have and where you can go. And once you identify that, it's a good exercise even to evaluate if you have old plans, maybe from old employers that you had that maybe you might be able to roll into. But ultimately, what we want you to do is to take advantage of that company match if your employer does offer it. Don't leave that money on the table. You absolutely want it, and we want you to have it too. Now, what we also want you to do is to try to push that needle. Can you save a little bit more? Once you reach that match, are you able to incrementally increase it? We want you to aim for 2% higher than what that match level is. I'll pass it back to Christine here. Maybe you can show us some other avenues that an individual might be able to take where it might make sense for them too.
So are you already making Roth contributions? Terrific. But can you increase it? Maybe go up 2%. Great time to always increase what you're contributing to your employer's plan is around pay increase times. Because if you get a pay increase and you stick a little of it in your retirement plan, it's not going to feel as much deduction in your take-home pay. Maybe you're not taking advantage of the Roth. How do you do that? Well, you could always increase what you're putting in, leave what you're already putting in pre-tax, but then start putting new contributions, additional contributions in the Roth. Or maybe you're pre-tax and you want to switch over. You could switch a portion of that pre-tax into the Roth, or maybe you want to do it all pre-tax into Roth. The one thing I want to caution anyone who's taking pre-tax dollars moving to the Roth is this is going to change your take-home pay. And so just be aware that when you move from traditional directly into Roth, you're going to see a reduction, even though you're going to have the same dollars going into your retirement account, because again, those taxes will be taken out of that Roth piece. You also just need to make sure you're diversified. So are you 100% pre-tax? Probably not unusual, since that was historically the go-to way to save for retirement. But just like you want to diversify your investments, it's important to diversify your tax situation. So think about maybe having some Roth dollars. And then we've mentioned some other tax advantages, the 529, the HSAs, the FSAs. Look and see if you can take advantage of any of those type of opportunities.
Excellent. And so as we close things out here, I think for many of you, there might be some follow-up questions that you have, or maybe you'd like to get into the weeds a little bit more about some of these different accounts that you might be contributing towards, or maybe changing around that strategy. Our financial fitness consultants are here to help you. So I'll leave this up on the screen here for just a moment, but take an opportunity, scan that QR code with your camera on your phone, and use this opportunity to be able to kind of dive into the details of your situation. We're ready to help, here to help in any way that we possibly can. In addition to that, as you know, and most of you, I know I see some names here that have been on over the last couple of months with our Fit for Learning series. This is something that we're going to be doing every month. So make sure that you're keeping our emails and things like that on your radar. To make it easy to get you registered for next month, I've got the QR code here as well for our next webinar, where we're going to be talking about what questions should you ask your financial advisor. And so we're going to be able to give you some insight there, especially for those of you that maybe haven't worked with an advisor before, or maybe you have, but you want to make sure that you're asking those right questions. We're going to help you to kind of navigate through all of that information as well. And with that, folks, I just want to thank you all for taking a little bit of time out of your day to be here. We've enjoyed your participation. We're here to help in any way that we can. So be sure to take an opportunity to reach out to us. And with that, have a wonderful rest of your day. And thank you again for your time. Bye-bye.